Live. This is where we review the opening price action of the stock market futures, and we'll talk about the week that's to come. It's going to be a very, very important week, and I'm going to make the argument that in all probability that yes, we will see volatility, but the volatility will subside probably by the end of business on Wednesday, if not Thursday, and we will have a new market to trade, different than one that we've been trading these past couple of weeks. And I'll go into the details of what I mean by that in a moment. So we have the futures open. I'm looking at the E-minis. They're only showing up spot 0.01%. That can't be right. Maybe it is. Looks like we're up more than that. Let's say hello to people. How's the audio? Audio good, folks? Stoney, good evening to you. Trader Isaac, hey Bob, if China sells Saudi oil with yuan, will this get gold, silver stocks above 200-day and to all-time highs in 2023? It could. I mean, the only thing that saved the U.S. dollar after they took us off the gold standard was the petrodollar. Now, if you get a petro yuan, it's not good. I mean, there's always going to be demand for dollars, at least in our lifetimes, probably because you have the derivatives market that's out there, and all of it probably, at least 3/4 of it is monetized in U.S. dollars. So there's always a demand for dollars, and that's in the hidden markets, the black markets. So, yeah, would it hurt the dollar? No doubt about it. I mean, you bypass the dollar and crude. I mean, the Russians know it, and they're going to do it. They're threatening to demand gold in lieu of even rubles. They want gold. They want the Western powers to go out to the gold markets. They haven't said this yet. This is speculation, so don't take this as fact. But the speculation is that they want the Western powers to have to take their fiat currency, their worthless paper currency, go to the gold market, buy gold, then hand that to the Russians. Why do the Russians want that? Well, they have massive gold reserves, and to have to take your paper currency and go buy gold is a humiliation for the Western powers, A, and B, the gold markets are going to say, I really don't want that. I'm not going to give you my gold for those worthless pieces of paper. That's a high risk on my part. I want more money. Price of gold goes a lot higher. Thanks, Trader Isaac. Thank you, RL. RL, hello. Chris Stockman, your opinion on XES. Let me write this down. We'll go over chart requests a little bit later. I don't have a lot to go over today. It was really a quiet weekend. Hey, Bob, you read the article about the silent mass? Yes, I did read that. Yes, it was China. Correct. That's correct. Yeah, I think they even came out and admitted it. So yeah, the Chinese are hoarding gold. I think that was their first buy in quite a while, like a couple of years, like a major buy. They're a big producer, but to go out into the market and to buy such a huge amount, that speaks volumes. That being said, I would warn. I went over this with members yesterday on the week ahead commentary, and that's where we do our analysis of how we closed out the week, similar to what we do on Thursday nights, and then we set up a strategy for the coming week. But I took a look at the U.S. dollar, and the dollar, let's come back to the stock market futures in a moment. We're definitely going to go over them. Don't go away. But the dollar had a pretty good week last week, and we appear to be setting up for a continuation breakout on the dollar, and we're broaching that resistance level. right now. It's only a 15-minute chart, but if you take a look at even a daily chart, we cleared one resistance level. We're at another resistance level, 4-hour chart. And you can see on a 4-hour basis that the dollar is moving out of that downtrend. You know, it didn't break out on a weekly basis. It rallied up into a resistance level, so a little bit of a rejection. That being said, you know, the weekly charts of the euro in particular, which is the largest component versus the dollar in this Dixie basket, it did not have a good week last week. Let's take a look at a weekly chart. And you can see that it was an inside week. Is this week or no? No, this is this week. It was a down week. Maybe it wasn't that horrible in that we broke out, we pulled back, retested. This may actually be a fairly good setup. Maybe I'm thinking about the yen. I think it was the yen that had an inside week last week. So if we see a euro weekly breakout and the dollar pull back, that would have me interested in possibly adding more to the precious metal trade. I think it was the yen that had an inside week. Yeah, it was. So yeah, the yen had a week last week. Um, it's right at support right now. Let's see whether or not it breaks. But right now, I would give odds to the dollar continuing to move up higher, at least in the short term. And that's the dollar there again, breaking out 4-hour time frame. Jeff, hey Jeff. Oh yeah, I want to go. Let's take a look at nat gas now. Yeah, up 11%. Yeah. So we have naked puts here on nat gas, but we also have naked calls on it as well. What I may do here, Jeff, if this continues, expect because we want to protect those calls as best as possible, and we also want to capitalize on the upside move here. So to get that tax loss write off, I don't want to buy the common stock. What I may do is use a synthetic covered call strategy. I'll share with you what that is. Basically, I'm going in and I'm buying deep in the money call options going out at least 6 months. And so that way you avoid that time decay. And if you get a an option on Boyle, which is what we're trading for natural gas, if you're getting an 80 and 90 delta, that'll protect that call that's above. And we're in the safe territory. We have the put offsetting the call, but we also get back into the trade long. But I also keep that loss, that tax write-off that I don't want to give up. So there's um, only a couple of weeks left in the year. Why do I want to give that up? So I'd rather just use a call strategy. TZ Burton, hello. And I think the reason why nat gas is up is that California was something out of California with cold coming in there. Yep, TF Howdy. Yep. You're not alone, pal. I don't know how that's gonna happen though. I like your attitude. Okay, so nat gas moving up higher. We're in the energy space. Let's stick with it. Let's take a look at how uh, crude prices will go with the light sweet, which is what we usually use. Light sweet crude catching a bid here. This is a 30-minute chart. I want to set up an alert for a possible trade here on crude. Now, we bailed out. We were short of energy going into last week. We booked profits there, and we saw continued weakness on Friday. So hopefully we get a pop there, and we rally the XLE up to 88. I'll look to reshort up at 88. Okay, so that's set. All right, let's stick with commodities here. Let's check out gold. Gold down $3 on stronger US dollar. No great shock. Silver had an awesome week last week. Let's check that out. Silver was just simply outstanding. Take a look at the weekly chart. Boom. Bullish reversal bar. They tried to take it down. Traders said, nah, I don't think so. Bid it back up. Love this chart. 15-minute view. We're down on the session so far. I'm not worried about it too much. Copper. Let's go to the weekly chart. We don't track many of these commodities throughout the week, so it's best just to take a look at a weekly snapshot of how it performed. Consolidating nicely here, still down below support. So copper looking interesting. Home heating oil. You can see I alert. If we break to new lower lows, I wait another week to get a fill up, and then I wait for it to hit down here, 234. But right now, God damn it, they're bidding it right now. Bastards. Anyway, sorry, family-friendly show. All right, sticking with the commodity space, let's take a look at weekly chart. Corn. Corn has been under pressure of late. Crude just broke out on that 30-minute alert I just set up. That was quick. So corn looking good, retesting support here. There may be a trade off of the support level. Soybeans, an up week last week, looking good, consolidating. Wheat was under pressure. It remains under pressure. This is what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, 10 consecutive down weeks. Tell me there's no trade there. We're at support at current. I think wheat for members tomorrow, we got to take a look at wheat and say, okay, do we have a trade here? 10 consecutive down weeks. Maybe just purchase WEAT or sell naked puts or put on a call spread long. All right, let's go to light sweet crude again. That alert just fired off, and it is clearly breaking out now. But no new higher high, which is the next step. A lot of buying in there. All right, let's take a look at equities. All right, so the Nasdaq is, that's strange. You had a bid up on the S&Ps. This is a 5-minute chart. Let's pull back a little bit too close to the. Oh, that's why. Yeah, they gapped up as well, but now they're off the session highs. So that's why it's showing as a negative. We are up relative to the close on Friday. So it looks like as though we're starting the week off pretty strong, buying into very important economic reports coming out this week. Well, one economic report, one Fed report or announcement. So NASDAQ looking good. The Russell 2000, same deal here, gap up, fading off the highs though. And where are my S&Ps? S&Ps holding that 20-period moving average, 15-minute chart. Let's take a quick peek at volatility. Now, volatility, we have an options trading business and we have swing trading business. And you know, the options trading business is purely for cash flow generation, and it's we sell the premium. We want to be the casino and not the gambler. Sometimes we're the gambler, but by and large, we use strategies to generate cash flow. So even though we had a sound week, all of our options positions are very, very favorable time decay, great theta decay. That's the Greek for time decay. The value of those positions really didn't go up, or I should say, the diminishment of value out of those options didn't go down all that much where we would profit. And the reason is that you saw this spike in volatility, and volatility drives the price of an option. So right now you have a lot of fear out there. You have economic reports coming out this week. People are buying insurance, bidding up the VIX. You're seeing weakness in equities, also bidding up the VIX. So as options traders, we're doing good, but the VIX is, it's good when a high VIX is good when you're selling premium. It's not so good when you want to cash out and roll your positions. So that should happen by probably end of business on Wednesday, then Thursday, once we get all the economic data out of the way. So for the most part, this coming week is the end of the year. So if you look at it through that lens, you'll be well served. I would caution about taking on any risky bets, meaning buying in advance of the Fed meeting. If you do, fine. Just stay small. Don't get too big. And that's the only time I really ever get hurt is when I'm too big in a trade. So, don't get too big. You're going to get volatility in the back half of the week. And after this week, you're going to have nothing but computerized trading. And you're going to see wide spreads between the bid and the ask. And they're going to manipulate this market, probably with a bias to the upside. We'll go over seasonality in a moment. Franklin. Hey, Franklin. Same to you, my friend. Yeah, I saw the imagery of that Sheik and Xi saying goodbye. It was a very warm handshake, and I can only imagine with that 3-day meeting what they were talking about. I'm sure that we are not going to be the beneficiaries of any outcome there. TF Hab, would it be okay if I did a copy and paste? I'm not sure what you mean by that. If you want to clarify, please let me know. Harold, hello. Welcome, sir. Trader Isaac, we showing an auto trend line on TrendSpider. Okay. 60% sale they're having, and then soon. I'll send the link out in a moment. Like Boyle did last week, showing level of interest or bounce or undercut and rally trade. I think that I like the setup. 10 consecutive down weeks. Trading is about probabilities, right? So what are the probabilities that you're going to get another week that's down? It can certainly happen, but we need to look at the chart. We'll do a little bit of analysis on that. We'll see whether or not there's a trade to be had there. So let's add that to the list. We'll go over I think it's the Textrium fund that has wheat. Yoga Mac, you changed your photo. Hardly recognize you. You bullish on the new? Is that the one that Freed or whatever his name is, SPG, whatever? He's pitching a new token. Yeah, SBF, that's what it is. Is worried about investors. Yeah, right. I bet he is. Tweet on NG. I see. Copy and paste. Absolutely. I heard that Russia wants to sell the oil with gold. Yes, we talked about that on Thursday, and I mentioned a little bit earlier. For one barrel for 1 gram of gold. Yeah. Uh, Spy, you got it. Okay. All right. Let's get to it. Okay, so we have an anniversary to celebrate. The height of hypocrisy. It was this day, 1 month today, that you saw the FTX collapse, and that resulted in $51 billion in lost collateral. And SBF still sits in the Caribbean, in the Bahamas, and he's a free man, and he's looking to put out a new token. He will be testifying in front of Congress, but he's just going to do it virtually. So this is going to be funny. So he's tweeting back and forth with Maxine Waters about how he's trying to snake out of this, and she wouldn't let him. But she did it very, very nicely. And she could be a real nasty person. So this is really, really sweet for her. So he was trying to get out. But this is going to be awesome to watch him testify. But really, that's no matter. It's just a side note. You and I bounce a check. You can see a cop come to your door. This guy loses $52 billion, and it's okay. It's all good. Nothing to see here. Okay, let's talk about the yield curve. 2s versus 10s. Folks, we began to see a little bit of a bid here. We are well off the lows of the month. And we've seen this a few times before. So this is not a Chicken Little type alert per se. But we are seeing a bit of a steep of the yield curve, at least on a weekly time frame. And for the benefit, I know that you folks that are here every Sunday, you hear me say this all the time. I'm sorry, I need to repeat it for those that are not familiar. The yield curve is an indicator that we use, and a lot of technicians use it, a lot of economists use it. They use it the wrong way, but we use it to identify a potential recession. Now, nobody wants to admit that we're in recession, okay? But we are, and because they rewrote the definition, they don't want to get in trouble with the government. So they say, oh, we may be in a recession some point in time in the future. We don't play that game here, but we're in a recession. I have the receipts to prove it. So overlaid here in gray is the S&P 500. In gold is gold. So you go back to the steepening, not the inversion. A lot of people want to talk about the inversion of the yield curve as being bearish for stocks. It's not historically. They use it wrong. What you need to worry about is the steepening of the yield curve. That means the Fed is being more accommodative. So they're coming to the rescue of something. Something has occurred or they think is occurring, and they need to come to the rescue. So it's usually after the Fed pivots. I'll go to a chart of this in a moment. That's when you see equities begin to roll over hard. So that happened back in 2000, financial crisis, COVID, and right now, here we are yet again. But really, nobody wants to talk about this. It's just, I'm going to play you a video in a moment. I find it astonishing, the matter-of-fact attitude that people have about the yield curve and how rarely it happens, and the devastation that has been wrought on this economy over the past few times that it has steepened. Each time seems to get worse and worse in rate of change in downside risk. So be aware of this. The only reason why I share this, because this needs to get remedied. It will get remedied. And the probability of it ending well for equity holders is not good. So what do we talk about here? We want to have gold. We want to have silver. We want to have gold mining stocks. We want to be short. So we're going to be looking on any rally into the back half of this year to reload as we were last Sunday. We took those shorts off, but we're going to be looking to put them back on, ideally at higher prices. So just beware of the yield curve. Now, I'm going to play you in a video in a moment, so there's a reason for me going over this. This I find hilarious. This is what I mentioned earlier about economists. They want to drink the Kool-Aid that the government tells them to drink. We don't do that. Right? So economists have never been as worried about a recession as today. So that usually means that they're wrong. Yeah, they're wrong because we're already in a recession. Percentage of respondents in the survey of professional forecasters expecting a negative GDP 1 year from now. They're expecting. Our economy went into recession in Q2 of this year. 2 back-to-back negative quarters of GDP is the very simple, widely used and acknowledged historical benchmark for determining when an economy is in recession. Now, the federal government pressured Wikipedia, probably every single dictionary out there to change the definition so they can come out and say, oh, we're not technically in a recession. And everybody drank that Kool-Aid and they're spitting it out as if it's fact and that this definition and these events never happened. So from our perspective, we are already in recession and have been in recession. And these guys are still waiting for it up to from a year from now. I'm trying to tee up this video, so I'm gonna try to stay on point here. So the Fed pivots. This is an overlay of Fed pivots versus the S&P 500. So Fed pivots. This goes back to the early 70s, late 60s. Drops 36%. Fed pivots, same time frame, 48% drop. Fed pivots. This is in the early 80s, 27% drop. Fed pivots. This goes back. This is the dot-com bust, 51% loss. That's on the S&P 500 alone. Nasdaq was down much more than that. Fed pivot. This was in what 2008. This is the financial crisis, and then we had COVID down 35%. So all these times, the yield curve was already inverted before these drops occurred. So it's the steepening that gets you. It's not the inversion. And there's a reason why I'm going over this, because I know I went over these charts in a moment. What I'm trying to point out is that if you're watching CNBC, you're being fed a narrative, whether it's willing or knowingly or unwittingly. I have no idea. Right? I can't prove anything. All I know is that what they're spitting out is absolute falsehood. So here's a look at consumer borrowing. Consumer borrowing continues to skyrocket. There's only one problem with that. For the first time this century, real wages are negative. Adjusted for inflation, wages are negative. How is that bad? Well, if you're putting all your money into food and your gas tank and your home heating bill, how are you going to pay off these credit cards? Nobody's talking about that. You're seeing repossessions of automobiles that these banks loaned up to 140% loan to value on being repossessed at a rapid pace. This is the Manheim used car index. Prices were in a bubble. They are now tumbling, and the banks are having to write off a lot of auto loans. You're seeing home mortgage delinquencies tick up. I went over that last week. I think it was 450,000 mortgages 6 months from the closing date were in arrears. So the consumer is not good. And simply because they haven't taken pitchforks to the street yet doesn't mean that things aren't good in their household, financially anyway. So here, take a moment. This is Josh Brown on CNBC, and he's from my neck of the woods here on Long Island. Let's hear the wisdom of I was going to try to say that he's not going to say that it's different this time. He's going to talk about the yield curve. He's going to try to say that it's not different this time, but then listen at the very end. Listen at the very end, listen to the very beginning, and then the very end. Here we go. Josh Brown.
The only trouble with the yield curve, I'm not saying this time, I'm saying you have to choose sides. Do you believe that the yield curve is in fact what causes the recession because it stops banks from lending? In other words, why would they want to lose money on the inverse of borrowing short, lending long? So do you think it's causal, or do you think it's just one of these things that is coincident with the environment that a recession happens in? If you think it's causal, which a lot of people do, here's the problem. Bank of America tells us there's still 1.2 trillion in excess savings sitting in people's bank accounts. And we really haven't had any kind of uptick at all in past due credit card balances, delinquencies. Almost nobody is having trouble except for Carvana that I can see. That might change, but the thing is, if the yield curve is this inverted, but the lending is not an issue because everyone's got plenty of cash, it might not serve as the same type of causative thing as it has in the past.
Okay, so his opinion is that it is different this time. He started out saying, I don't want to say that it's different this time, but at the very end, it's coincidence. So it's different this time. It's not different this time. All he's citing is Carvana, which is a major online used car seller. They're gonna be bankrupt soon. He's not acknowledging that the reason why Carvana is collapsing is that the used car market is imploding. Cars are being repossessed. The banks are already incurring the losses. The yield curve is not causal. It's a smart market. It's the bond market saying something is very, very wrong here. We don't want to lend long because we know that delinquencies are picking up. Credit is not looking good moving out. We have used car loans that are going bad. Things are looking very, very poor. So no, the yield curve is not causal. It's the market being efficient. The markets are telling you there's something very, very wrong out there and something is about to break. He doesn't get it. And he's running money. Sorry, it drives me crazy. Okay. Let's go over some comments here so I can calm down. They have to arrest SBF, George Gammon, and Michael Saylor. Don't always agree. Both agreed on this. He's got to go. I mean, you want to talk about sending the wrong signal. I mean, if they let this guy walk, the level of fraud that you will see in this country, globally, will be incredible. As long as you donate to the appropriate party, you're good. That's all that they're saying to you. If this guy didn't donate $40 million to political parties, I'm not even going to say which because I don't want to get political here, he'd be in handcuffs right now. You know it and I know it. You would have Navy SEALs dropping in on his condo over in the Bahamas. They would have taken him out in the middle of the night. And the Bahamians never would have known that he was there or that the SEALs were there. He would just wake up one morning in Guantanamo. This is crazy. We're in a recession, agreed. Government's talking like it's a joke, and the citizens need the government to explain to them. Yeah, that's the last thing we need, right? Thank you for the comment. I still keep hearing people say we might go into recession. We are there. Correct. Please, I beg you, educate them. Educate them. Got to talk to them. People are getting their information from this guy, and they have no idea. They have no idea that this time bomb, most everybody on this live stream has lived through at least, the 2000 bust, right? Everybody knows what it was like. So This was the mechanism that helped tell you, hey, you better buckle up, pal. There's something very, very wrong out there. This is not normal. And he wants to, he's blowing it off. He's whistling past the graveyard. Again, I don't know whether he's ill-informed, uninformed, whether he's pouring the Kool-Aid out for people to drink. I don't know. But it's wrong. Let's talk about the coming week. All right, so we're going into the new trading week with the Schiller PE ratio at 28.79, the mean 16.99. We remain very, very overvalued. We have earnings. There's something else I wanted to go over. Here, before I move on to earnings. So this is posted by Liz Ann Saunders. So we have an expensive market, right? And CPI, this is not what I wanted to go over. No, I lost it. Basically, she put out a post about how they needed to bring down forward-looking guidance on earnings. So expect this number quite possibly to jack up higher in January as earnings get announced. So watch out for pre-announcements. Many companies have stopped giving forward-looking guidance. So I don't know whether or not that gets them out of the way of having to pre-announce or what, but look out for guidance being lowered. And also watch out as we proceed into the new year for expectations for Q4 and Q1 out of the Atlanta Federal Reserve. They usually put out forecasts. It gets adjusted many, many times before ultimately it gets reported out with the final number. But watch out for those GDP expectations for Q4 and Q1. They usually trend lower towards the ultimate end of the reporting period. All right, earnings this week. There's not much out here that we would want to do earnings trades on. Very quiet week. Maybe Adobe. Adobe is one that we've traded before. Oracle, that's not a very high dollar stock, so I doubt we'll trade that. Accenture, I don't think I've ever traded Accenture before on earnings. So not much on deck here in terms of earnings. So in a way, this is good. You're not going to have a lot of companies out there with bad news coming out this week because they missed. You saw Lululemon take it on the chin on Friday, down dramatically, $1.8 billion build in inventory. That's a lot of yoga pants. So expect markdowns there. And that's consistent with what we heard out of Target, what we heard out of Walmart. So these retailers are going to have to mark down, and that may actually help CPI at least for a quarter or two as they mark down these products, and it's reflected in CPI. But remember, after they draw down their inventories, it's not as if they're going to reload those inventories again. They're going to keep their inventories small until they know they have a healthy consumer and a market to sell into. So prices will, after catching a dip because of the write-downs on excess inventory, they're going to go right back up again on new merchandise. Let's talk a little bit about seasonality. And we could take a moment here. We could talk about the S&P 500 for Yoga Mac. That was one of his requests. And the S&P 500 was down in the week. And it's no great shock. This is a weekly chart, S&P 500, or spiders, I should say, appropriately. And you can see that these fractal trend lines. Oh, folks, for those of you that have been sitting on the sidelines waiting to get TrendSpider 60% off. That's going to expire soon. So take advantage of it. I just put the link into the chat box. All right. So S&P 500 weekly chart. We rallied up and into resistance the prior week. Last week, a rejection. No follow-through effort on the part of the S&Ps to continue on the breakout. The stochastics, which is a momentum indicator, one that we use quite frequently here, they continue to rise. So I'm not in that camp, despite all of my bluster about the yield curve this and Josh Brown that and CNBC this, that doesn't mean that I don't believe that we're not going to have a rally into the back half of the year. I think that we're going to. I think that what we need to do is get past something that I should have gone over already, and that is that we have CPI coming out on Tuesday. That's a consumer price index. And of late, for whatever reason, the Federal Reserve has been citing the CPI. They historically don't use the CPI. They use the PCE report, but they've been talking about the CPI report. Watch out for the CPI report this week. It's going to be probably of magnified significance, and that's the measure of inflation on the consumer. And Liz Ann Saunders, she put out a tweet, which I showed earlier, how average hourly earnings, and this is basically her warning that, we may see potentially pressure on CPI to the upside because average hourly earnings ticked up. I don't know about that. We've seen, I don't disagree with her. That's going to be additive to the CPI. But keep in mind that we're seeing huge drops in commodity prices, major drops, even food prices. You're seeing it in gasoline. You're seeing it in oil. This is gasoline, retail gasoline, year-over-year basis. Prices are clearly rolling over. Percentage change, 0, year-over-year. So I think that, you take a look at the headline CPI, that is probably going to be favorable. The number you're going to need to watch is the core CPI. Now, the core CPI, she's going to be right here, is that the core CPI is going to have hourly earnings where it's not going to have food and energy. So pay attention to, I think the headline number is in all probability going to come out stock market friendly, but that's the headline number. That's what's important to a lot of traders. What's important to guys like me and to macro traders is that they want to look at the core, because the core, that backs out food and energy, and that's really what the Federal Reserve pays attention to. So they may trade off the headline news. If we get a weak number, the market will rally. If the core CPI comes in maybe a tick higher to about what's expected, you're going to see a rally. If it spikes up measurably, I don't think that the markets are going to be able to ignore it. So watch out for the core number. Then on Wednesday, we're going to get the Federal Reserve announcement. So the expectation is that we're going to get a half basis point hike. I think that's consistent with the messaging from Jay Powell the last time he spoke. And I don't believe they have a January meeting. I think they meet on February the 1st, I believe. Fact check me on that. And they will probably set expectations that there will be another rate hike. Will it be a half point? Will it be a quarter basis point? I don't know. We'll have to listen to his statement. And the markets are pricing in. If you're worried about a shock on Wednesday, the markets are pricing in a half basis point move up higher. I don't remember a time so far where the Federal Reserve, under Jay Powell anyway, has come in and surprised the market with something different than what the market had priced in. And you may say, then why is there so much volatility? Well, they're going off of his statement. They're looking at forward-looking guidance, and that's what drives the volatility. Comments. So if CPI is better than expected, what do you think will happen? I think we rally. I think the stock market rallies, no doubt about it. And I think that's going to include, that'll include the mining stocks as well. Why? Because pressure will come off of yields, pressure will come off of the dollar, and money will rotate back into equities. You may see some selling of bonds, which would drive up yields a little bit, but that money would find its way into the stock market because people are going to want to take advantage of this seasonally favorable period of time. People are aware of it. It's out there, especially retail traders. I mean, not retail, professional traders. 12 days of Christmas just around the corner. Will Santa come early? We hope so. Bob, we're going to get you more views on Twitter. Is your email on your website? It should be robert@thecontrariantrader.com. We'd love to get that. I really would. Thank you, Yogamek. Free Corzine 111. Okay. Trader Isaac, we don't want them to make an example of SBF. Yeah, I agree with you 1,000%. No doubt about it. The bubble's beginning to explode. Think about what's been going on. Things are becoming unwound for a lot of the powers that are in, a lot of the people that are in power right now. They're being exposed. I see. No, so you know what? It's funny. I don't know what this is. I really don't. I swear to God, I don't know what this is. But I have been on their website. I don't know who these guys are. I have not been on this website. I'm on Jeremy James. I have been on this website. But yeah, there's an apparel company that I buy stuff from, and I don't know who these people are. So this is not always accurate. I guess I don't know why they target me for certain things. So yeah, there's an apparel company that I shop on. Yeah, these guys here. They're pretty good. Good prices. Yeah, see I have my account there. If you want to check them out, they have a lot of stuff. Really good prices. So all we're looking to do here is provide value. And I have no affiliation with them. Okay, let's get back to the S&P 500. We have the S&P 500 weekly view. Resistance. We hit resistance. We fell back down below this VWAP. This is acting as an overhead ceiling. We were able to break out above it, consolidate, then we gave it up again. But you can see it was resistance here, and now we're back below it. Down volume was light last week. Let's talk about the daily chart for a moment. The daily chart was pretty bearish on Friday, on volume no less. Stokes is still very weak on a daily time frame, but they're nearing oversold levels. So I would not initiate a new short trade here. We booked our profit on a short of the spiders last week. We're out of it. The only short that we have on is Hibbett Sports. That's it. But we're looking to reload on shorts on any rally into the back half of the year. Let's take a look at seasonality. And we'll go with the weekly view. This goes back 19 years. The week that we're going into, I don't think this is right. There's 3 weeks left in the year, right? 1, 2, 3. I'm not sure why they're showing. This is weird. I'll have to get a clarification on this, but they're showing that you're seeing some strength into the back half of the year. So that final week of the year is clearly a powerful week historically. And on a monthly view, S&P 500s, they may be having some technical issues here tonight. Oh, they're making me log back in. That's why. Let's bring that back up again. That was really weird. No, still the same. All right, let's go to the monthly view. Monthly view. This is my mouse. Monthly view, we're up 67% of the time. But if you drill down a little bit further, like this is 19 years worth of data. So you have a couple of bear markets in there. If you want to pull back just since, let's say, 2011. it hadn't changed. Didn't change at all. Oh, you know what? I got to exclude these bear markets here. Still didn't change. Okay, 67% of the time. Up month. And how are we so far on the month? Down big. So while I expect a strong close to the year, it's going to be a down year. And we have our reasons for being concerned about this coming year. We talk about it all the time. Uh, Other economic reports coming out this week, very, very minor stuff. So nothing really to talk about. Let's do some chart requests. All right, we have XES. This is the oil and gas exploration ETF. So we already did the futures. I would really watch out tomorrow to see how nat gas and oil settles out, because there's a very, very tight correlation with these ETFs, the XLE, XOP, XES, very strong correlation with them and the price of oil. So if you see oil jacking up higher, there's a strong possibility that these names move up higher as well. So I'm going to talk in terms of, I haven't seen the futures. I'm going to talk about the close on Friday, and it wasn't pretty. But beware, again, they're spiking up in oil is spiking up in the pre-market. So we are at support on the month. This is a monthly chart, rising lower band of support in blue. That's the automated trend line on TrendSpider. Take it off, put it back on, click of a button. So what I'd be looking for here is a breakout. I think this could be bought on spec, new week, new monthly lower low, get out, take it, just stay small in the trade, take a small loss. So you could buy against this rising lower band of support and then add more on a breakout above $78 a share. And we're set. Set it and forget it. Now, on a weekly view, you can see that we're in a trading range on XES. And we rallied and broke out. And this is very bearish stuff. That doesn't mean we're going to go lower from here. It was bearish here. This was a sell signal because we broke out the week of November the 7th, and then we were rejected the following week. That's a breakout point failure, also known as a bull trap. That's a sell signal right off the bat. So the shares have pulled back since then, and it looks as though we are seeing a bunch of moving averages stack up immediately below. There may be bids down here, especially if oil spikes up higher. Daily view. Yeah, we broke down below support on Friday. We may get a rally back in an effort to try to recapture $71 per share. If it fails to recapture $71 per share on a rally back, that probably just means that you have people think that they're getting a bargain, and they don't understand that the shares are breaking down, and they may get hurt. So I would not buy into resistance. I would only buy on a close above 71. Let's call it 71.50 to be safe. And before I put that trade on, I want to take a look at crude oil prices, make sure they're moving up higher as well. Hey, Jody, welcome. Oh, no matter when you get here, it's fine. Great to have you. Patrick, hey, brother. Watching with William. Hey, William. Your grandpa's a great guy. TF Hatter, former JP Morgan Chase Company gold and silver trader Christopher Jordan was convicted of you. They're always in trouble for silver, manipulating silver. Allegedly. I don't want to be in the crosshairs of Jamie Dimon. Illegal spoofing trades and market manipulation. Yeah, I think that was just settled, right? RNG. Okay, you got it. That'll probably be the last one for the night. Let's take a look at wheat. Remember, we started off the show tonight taking a look at commodity prices, and wheat has been down 10 consecutive weeks in a row. So the question is, do we have a trade? You know, a lot of people will say, oh, God, look at how weak it is, 10 consecutive down weeks. What do they know that we don't know? Well, I'll put it to this way. What they don't know is technical analysis and probabilities. The probability of wheat continuing to go down another 10 weeks, another 2 weeks is highly improbable. So there needs to be a trade to be at least hypothesized. I can never say that word. Hypothesized. All right, so let's begin. Let's do high level. High level. Where are we on a monthly time frame? And we have retraced the entire move of this breakout. We were consolidating all through 2021. Then we blasted off in February. What happened in February, folks? This is a contrarian tell. Contrarian tell. Who could tell me what happened in February to cause this to happen? So we have retraced the year's move, and we are at support. The monthly Stokes are still declining. Volume is declining. Good. I think there's a trade to be had here. So I'm not seeing any answers to that question. What happened in February of this year, the Russians invaded Ukraine. So all of that, I was wondering, man. I'm saying, wow, that's strange for Dane, man. If you have if you have a sex meta, please. I was looking at it in the corner of my eye, and I'm saying, what am I missing here? So he made the correction. That's too funny. That's too funny. Yeah, TF Hatter got it. TF Hatter got it. Okay. Patrick, he got excited when you said hello to him. Ah, cool. I'm glad. That's fun. I have a new baby here. I have a new dog I just got. He's puppy, 8 weeks old, half black lab, half a Great Pyrenees. I don't know if you know those dogs. They're beautiful dogs. I have video of his father and his mother, and he's beautiful. I'm gonna bring him in here probably next Thursday. But he's home now. We got him last night, and he's a great joy to have. All right, so let's do a deeper dive here. Let's take a look at a weekly chart. Yeah, we're bouncing around support here. I like the 745 mark. If they push it down further, I think this has to be bought. Or we could sell naked puts. I'm liking this. What are the let's take a look at the implied volatility here. Nah, it's not worth selling the puts. You're not going to get paid for high IV. But buying the common is definitely an option. Pardon the pun. Stokes daily time frame, momentum indicator. What is that momentum indicator telling us? It's telling us selling is abating, and now these Stokes are hooking up, putting in higher highs. So while the weekly chart is definitely ugly on wheat, I think that we have a trade here to the long side. Where do I think it's going to go? Right up here. Probably get a short squeeze up to 784 to 789, and then we'll pull back. We'll do a double bottom setup. You could argue that we have one here. I don't like that one, though. I'd rather a more steeper one, pull back, and then a breakout. So wheat, we're going to be talking about more this week, folks, in the members forum. RNJ. RNJ. I'll get this right eventually. NJ. J, Bob. J. Now, I typed this in accidentally. RNG, Ring Central. I like this daily chart. RNJ is not coming up. I may have written that down wrong. Whoever requested something similar to RNJ, please enter that again. When do you see rooster bullets coming down? Eggs? Oh. That's a good question. I'm no longer in the Cal Main trade. We booked profits there. You could argue that, the performance of Cal Main Foods, which is one of the largest egg producers in the country, they have really stalled out here. This is a daily chart. Let's take a look from a higher level view. Still a strong chart. We're consolidating gains. I don't have a chart of eggs per se, so it's hard for me to analysis. I can only base it off of the chart price action of Cal Main Foods, which is not the best way to do that. Rick, I had a Great Pyrenees. If you shave them, they stop shedding until the coat grows back out. Okay, good info. Thank you. Thank you, Pat. Appreciate that. Yeah, it was 6 months since we lost my my golden, and the house just hasn't been the same. Really hasn't been the same. All right, let's. Somebody else requested one. Oh, Ring. So it was Ring. Okay, good. I'm glad you select. I like this chart. So nice long consolidation here. The only thing, this is my own opinion. This is what would sabotage a trade for me. If you don't have the police enforcing crime anymore, then what's the sense of having Ring Central? They'll go to the expensive houses, but in New York here, I mean, I have zero confidence in if I call the cops that they're going to come in a timely manner. So long consolidation here, looking good. Stokes on a weekly time frame, rising up higher. Daily view. I really like this setup. I really do. We're in a tight consolidation. I did not draw these lines. That is the AI doing it for you. Put them back on. I think Ring is going to break out here. So I would give it a buy, and I would nibble here, scratch the edge, and then on a breakout, buy more. Stochastics looking good, beginning to push up higher. So Ring Central looking very, very good. And last one for the night. Let's actually, Jody's going to be the last one for tonight. Cold. We'll do Meta for Dane. And then cold for Jody. Okay. Meta. It's done a lot of nothing, really, right? Just bounced around for the past several weeks. It did manage to recapture support. And my alert fired off. Let's remove this. You have resistance immediately above. I would check the short interest on Meta. There's probably a good number of shorts setting up for short squeeze. So interesting chart. I'd like to see a push above, let's call it 128 and a close above that mark before I got involved with it. I think this is one you could also sell premium in, sell naked puts. You could be pretty aggressive with that sale because I don't think there's a lot of downside risk here for the next couple of weeks. I think that you could be pretty aggressive. Let's take a look at the implied volatility on Meta. It's probably low because it hasn't done much. And it is very, very low. Very, very low. So if you're just looking to reduce your basis cost, you don't want to buy right now, but you want to get paid and generate some cash flow, and you want to own Meta, be aggressive with your naked put selling. Have the shares put to you. If you can get a buck on a put at, let's say, 115, 110, the shares close below that mark by options expiration. Well, you just discounted your basis cost by A, waiting for the shares to pull back, and by B, collecting premium. Bob texted you a picture of both the kids watching the show. All right, sounds good. Cool. Thanks, Pat. Appreciate that. All right, cold. The lovely Jody. Oh, okay. So yeah, we kind of talked about this already. Now this is the short ETF. No, Jody, no. The chart looks okay. It looks okay, but right now you have nat gas in the spot market, which is spiking up higher by over 10%. I don't know if it's pulled back yet, but I'm sure it's still up. Yeah, it's still up over 10%. So as a contrarian trade, it could be good. I know that we're going to be running right up and into resistance tomorrow. It looks as though you're going to get more of a pullback here. They tried to break it out last week. It was rejected. I would look for support at $11 per share. And you may be saying it's probably not going to get there. It could. I mean, this is very, very volatile. It's a leveraged ETF. You have some support where we closed on Friday. I'll tell you, the indicators look pretty good here. They look bullish. Daily view. Now, the daily view doesn't look that bad. It's just a simple pullback off of resistance. Now, we could overlay that weekly resistance on top of the daily chart. You can see you have a lot of overhead supply here. Dash line is weekly resistance on a daily chart. TrendSpider 60% off right now. Use the link below. And I would wait here. I would wait to see if this rally is for real on nat gas. Wait for some topping action. I think this is one that you're going to need to revisit, unless, of course, this is optionable and you want to look to sell out of the money put contracts to reduce your basis cost. That's the only trade I see here. If you want to trade this position and you want to manage your risk first and then think about making money. You manage risk and then the money follows. So that would be my suggestion to you: is see if it's optionable. If you have the options authority, the options, is it tier 2? I think tier 2, you can do naked put selling. That's one strategy we'd want to use because you do have some decent support below. This is weekly support where we bounced off of here in orange. But obviously, again, that spot market right now is ripping up. Who knows how that's going to play out? So just take a step back. No rush. It's all good. Is this optionable? Because this is going to get killed tomorrow. Yep, it's optionable. Market makers are anticipating around a $3.50 move in either direction this week. So keep that in mind. All right, so right up here, deck 16 expiration right over here. That's a big move, okay? $3.50 move on an ETF that's trading at 16 bucks, all right? So very, very volatile. I would sell puts on weakness and do it out of the money. Implied volatility here is very good. I like the naked put trade here on weakness. And that is it, folks. You are welcome. That is it, folks. Hey, folks, thank you for being here. It's my honor. Click, like, subscribe, please. Don't forget TrendSpider below. 60% discount. They have a 7-day free trial offer, and that discount is expiring soon, so take advantage of it. Everybody have a profitable trading week. I'll talk to you soon. Be well.